Should you do a Roth IRA contribution while you're working? We've all heard about how Roth IRAs are better in some ways than regular traditional IRAs because of the tax benefits when you take money out. You see, when you have a Roth IRA, the money you put in, you pay tax on it at first, but it grows tax free. When you take it out, it's tax free, and the growth is tax free. So, should you be contributing into something like that while you're working, or should you wait until you're retired when your taxes might be less, when your tax bracket is less, and do a Roth IRA conversion? Well, today we're going to talk about the details of doing that. But first, my name is Robert Martin. I'm the president and a partner here at Zenith Retirement Planning and a chartered financial consultant. So with that said, let's dive into it. Today we're going to go through a program called Retirement Analyzer, where I look at a family's numbers, whether that's income, assets, tax, liabilities, and it gives me a nice snapshot of where they're at. So today we're going to go through a family that I serve because it outlines this example perfectly whether you should be contributing to a Roth IRA while you're working. So let's get into it. This person, or this family, wife's retired, and husband is hopefully shortly behind her. But he loves what he does, so he doesn't really know if he's going to retire now or in a couple years. He's an electrical engineer, and he makes about $360,000 a year. And as you can glean almost immediately, he's probably in a high tax bracket, isn't he? Besides that, Social Security benefits, that's what he's counting on for retirement income besides his savings, is about $4,500 a month between both him and his wife. Now I want to go to assets, and the only reason I want to go to assets here is to outline something. Can you see right here underneath tax analysis and tax classification, this red bar? Well, it tells me that his qualified balance, which means the money he has sitting in IRAs, 401ks, or 403bs, he has about $1.8 million there, about 50% of his money. Now, in retirement, you actually have a deadline for taking money out of this account. It's called a required minimum distribution. The government doesn't want you to keep deferring your tax bill forever, doesn't want you to keep not paying your tax on this money forever since you've never paid tax on your IRAs or 401ks, and so they give you a deadline. And as of 2023, that deadline is 73. And so they have to go and calculate based on an equation how much they have to take out when they're 73. So when they're retired, they'll be counting on their Social Security and on those RMDs. So with that said, let's look at their tax situation. In 2023, they're still working. And what you see here is a breakdown of the tax brackets. And on the rightmost column, you see a breakdown of a 1040 basically. You can see his wages are about $360,000. He's collecting a little bit of interest from his savings accounts, about $10,000 there. Brings him to a total of $374,000. Now the next step when you calculate your taxes is you go to your deductions. And you're usually given two options. Option number one is you're given an allowance by the government called the standard deduction. So if you're single, you have it. If you're head of household or married, you have it. Well, if you're married and you're over 65 or blind, they give you an additional amount. So total deduction you'd have is almost $31,000 if you're over 65 and you're married. Your second option when you file your taxes to get deductions is by itemizing, which means counting up all your qualified receipts and using that number instead. For this couple, they have $46,000 of deductions, which is more than their standard deduction, and so they take their itemized deduction instead. And so we take their itemized deduction and subtract it from their total, and then that brings us to taxable income. And as you can see, it already makes sense to do that because instead of paying X amount of tax on 374, you pay that on 328. Now that 328 is going to populate over here in the tax brackets, and the way these tax brackets work is between $0 and $20,000 if you're married, you pay 10% in tax. Between 22 and $90,000 of income, you pay 12% in tax, and so forth. Well, their total 328 of income brings them in a 24% tax bracket. And it's here, while they're working, that he's been contributing money to his Roth IRA until we had our tax analysis meeting, because he knew Roth IRAs were great. He thought that he could create a tax savings by contributing to a Roth IRA. Here's the thing. Right now, when you contribute to a Roth IRA, you pay the tax now instead of later. Well, while he's working, that means he pays it now while he's working. And that puts him in a 24% tax bracket. And he's contributing between $7,000 and $15,000 into his Roth IRA and paying tax at 24%. Just so you know, the alternative would be contributing to a traditional IRA where you don't pay any tax today, you pay tax in the future because you hope taxes will be less. So those are his two options, and he chooses to pay tax now. Here's the thing. If I go forward to 2031, in 2031, he's been retired for many years, and his RMDs also start. That's the thing he has to take from his retirement accounts. And you kind of noticed immediately when I skipped forward a couple years, he's actually in a much lower tax bracket. He was in a 24, now he's in a 12. And the reason it works out that way is his Social Security is fully taxable. But the thing is, if all you had on your 1040 or on your tax form was Social Security, you actually wouldn't pay any tax. It's only when other income is on your 1040 does it trigger a formula that says your Social Security is taxed. And that's exactly what happened here. His RMDs were about $80,000, or will be $80,000. And that triggers his Social Security to be taxed. So together, his taxable income is about $80,000, which puts him at 12%. The funny thing is, he doesn't start that until 2031. In 2030, he doesn't have that RMD thing happen yet, and so he practically has no tax. Remember, because Social Security itself is not taxed. So that means between 2023, when he's working, and he retires, and 2027, and then in 2031, his RMDs begin, he has 5 years where he could contribute to a Roth IRA in a very low tax bracket. Because remember, when he was working, he was in a 24%, and he's paying tax on his Roth IRA contributions then, when he could wait until 2027, or when he's retired, when he's in a much lower tax bracket, and pay tax on his Roth IRA contributions at 10%, or 12%, or even 22%. Even in 2031, when he has a surplus of income come in, it's only putting him in the 12%, which is still much less than when he was working. So it makes sense for him to pay tax on his Roth IRA contributions when his tax is less in retirement, instead of doing it while he's working. But here's the catch. You actually can't contribute to a Roth IRA unless you're working. So he technically can't contribute to a Roth IRA, but what he can do is a Roth IRA conversion. And that is the act of taking money from your traditional IRA, your 401k, or your 403b, transferring it directly to your Roth IRA, either a little bit or all of it. You pay tax on the way through, but you end up with money in a Roth IRA. So instead of contributing to a Roth IRA while he was working, this person and this family should wait until he's retired and then do a Roth IRA conversion. That's how you'd create the most tax savings. So that's the situation if you're working, you're making some money, and you anticipate your taxes actually being less in retirement. If that's the case, then you wouldn't do a Roth IRA contribution while you're working. You might consider doing a Roth IRA conversion when you're retired. Let's say you're the opposite though. Let's say that while you're working, so I have a W here for working, you make about $80,000. Well, that puts you in a 12% tax bracket. Okay. And then when you're retired, so we have R for retired, between your Social Security, between a pension maybe, and then your RMDs, let's say in retirement, your income's actually going to be something like $120,000. And yes, this actually happens. That would put you in a 22% tax bracket. So the question is, should you contribute to a Roth now, which means you're going to pay the tax on the money now versus later? Okay. Should you contribute to a Roth IRA now when you're working, pay 12% on the money, or should you wait until retirement when taxes are more and put money in a Roth IRA then? Well, the question is a good question, but the answer is you would actually do it now. If you did it later when you're retired and your income was more, you would pay 22%. So here I can make it very easy. If you're making a lot of money now and you don't think you're going to be making a lot of money in the future, well, you should contribute to a Roth later. If you think that taxes are actually going to be more for you in retirement, then you want to pay taxes today. With that said, it's always a pleasure explaining and breaking ideas down for you and the retirement community. If you have any comments or questions, please drop them below or give us a thumbs up because you thought the content was great, or give us a thumbs down if you thought the content was okay. Either way, hit that subscribe button for future content as we continue to improve and grow our community, and look forward to seeing you on the next one.